We're back. It's 2023. Where does this year take us?
It's been a crazy year. The last year has been unbelievable, Corey.
Well, for our listeners today, it's the first time that we've had a chance to be in person for a podcast because of the pandemic. So I would like a big GFY to the pandemic, and it can beat it. I've had enough of that.
Don't come back.
Don't come back.
So much changed. Our format had to change for a while. It looks like it's even changed for our supplier here, the editing company we use. And here we are sitting and doing video, which is amazing.
And we've grown in the last year and a bit. Our team has grown dramatically. We almost doubled in size.
Yeah, it's been a big shift for us.
It's been a lot of
Very
growth, a lot of great changes that have happened. And today we just wanted to spend some time talking about the outlook. Where are we going? What's going on in the world of wealth management and financial planning? And what do we think the tea leaves are going to produce for returns in people's portfolios? And what are things they should be considering? And so, it's going to be a bit of an open forum. We actually have people to introduce here today.
We do. We're lucky.
We have Michael Lutes, who joined us about a year.
Yeah, we started kind of really getting things together last March, I'd say, and April it became a little bit real, and then really got integrated throughout 2022.
And we also have Louai Bibi, who is our new associate advisor and very much a rising star in the firm, and we're super happy to have him here today.
Much appreciated. It's this is my first podcast, so I'm an avid podcast listener, but first time being on one, so this is exciting. I'm excited.
Well, you should be. It's look what it's done for Corey and I.
Right.
It's changed our lives.
Right. There's a few less gray hairs.
No, or more. I'm not sure.
Yeah, right.
You're going to end up looking like me in about 6 months.
Okay.
Yeah.
All right.
10 years, you'll look like Brian.
Yeah.
Thanks.
We also have Brian, who's with us virtually today, which is also something that the pandemic has really brought to light. The world of virtual and video and conferencing and the love-hate relationship that we all have with it, but there is most certainly some conveniences surrounding it. So one of the things that I wanted to kind of touch on is, what's happening in the wealth management world? What's happening with financial planning? And it's a broad-based topic that the industry kind of throws around. And we wanted to take some time to discuss that. And like I said earlier, we also wanted to kind of touch on some of the things that are pain points for clients, things that are keeping people up at night, those types of things.
Yeah. Well, it's been a lot. It's funny, you look back at the last, year, 6 months, we've had so many critical inflections in what clients are dealing with. We're talking to clients. At one point 2 years ago, we're having a great recovery after COVID. Like there was a lot of fear and retraction during COVID. Suddenly we had some great performance. Clients seemed happy. People were getting back out again. And then, of course, inflation starts to hit and we have higher interest rates and fear again. And again, they're kind of reaching back out to us. That becomes problematic. So that's a conversation we've had to really spend some time on over the past 6 and 12 months, reassuring clients, talking about their plans, talking about their goals, where they're going, why they're doing what they're doing. And sometimes I think they worry it's not working. I think sometimes they fear that whatever path they're on is wrong. Maybe something's not working properly, and that's sometimes not the case. They just need some reassurance, some better understanding of what's under the hood.
Well, the media certainly doesn't do itself any justice with helping people calm their fears or help them sleep better at night. One day the market's up, one day the market's down. China's shutting down. Ukraine, we've got a war. We've got oil going through the roof. We've got oil coming back down in price. We have ongoing supply chain issues. We've got labor shortage. So it's kind of this, there's a lot of arguably doomsday type fear going on out there. But I think that's what differentiates being a good advisory team
Yep.
versus one that's maybe operating from a transactional standpoint, right?
Yep.
We pride ourselves on sitting down and taking the time with a client, talking through their fears, talking through where they want to go, and that kind of probably brings us full circle on talking about planning and
Sure.
where we want to take things.
Kind of like, to me, it's like it's part of your introducing the team earlier, and it's about the uniqueness of having a really good team and an assembly. If you look at even how you and I came together, your background, working with some of the best investment minds in the industry. Lucky enough to have Mike join us, being a certified financial planner, having a specialized, unique way to pass along value to his own clients, and very fortunate to have him part of the firm, which is excellent. And Louis, we were just talking before we started the show here. It's almost coming up to a year that we started originally talking to Louis. So what we were needing was
the chosen one.
That's right. That's right. We needed a good associate. We needed. It was time. It was time for us to have somebody come on board that could assist Corey and I, and the work that we're doing, the planning that we're doing. That advanced planning. And Corey came in, or Louis, in from the bank, a major bank. Started off these conversations early, talking about his background and his knowledge. So, and I know he's been really well liked as he come on board, and the clients he's worked with. I mean, he sits in a lot of the meetings with us. It's been great, and your passion obviously is rubbing off on a lot of people. So
like Batman and Robin,
basically.
Peanut butter and jam. It's incredible.
It sure is. And then, of course, we couldn't be here even having these conversations today, or like holding the brand up, Brian, if it wasn't for you. Like Brian's the founding member of Ecivda, as a past president. This is your 51 years, Brian, in the industry, now going into 51 years in the industry.
We started at birth.
50. Yeah, basically. We used to have long hair. I tell that joke, but Brian's a long-standing, landmark in the finance industry, especially here in Ottawa. A lot of great client relationships, and the knowledge and experience and the ability to build this brand, and it is evolved into what it is today, and it's going to continue to evolve, and that's why it's so exciting.
So, Mike, we wanted to kind of, as we talk about planning as one of our topics of discussion today, what are your thoughts, concerns, outlook in terms of what is going on in the planning world, and why would someone actually want to engage in financial planning?
That's a fabulous question, and one we get often. I mean, there's no sort of shortage of interesting things going on, but from my perspective, and of course, it's mine of having my own kind of 10 years experience, but also the things I've learned from people that are more seasoned than me. The advisory world kind of came from this space of being, as you said earlier, transactional. And I'm not going to pinpoint how far we have to go back to where that was the norm, but I would say back in the 60s, 70s, 80s, when people had their stockbrokers, and that was kind of the only advisor they maybe listened to when it came to their money. It was a very transactional type of relationship.
And for our listeners, what does transactional actually mean?
What does that look like? What does that feel for them?
I mean, we may have to ask Brian if we want to know back in the 60s, 70s, 80s what the transactional was like. But what I mean by that is, you kind of called up your stockbroker for, hey, I've got some money. Maybe I just had an inheritance. I want to invest something. Like, what stocks are hot today? What should I invest in? And they were kind of giving their orders of what to trade that day and where they were going to make some money, and they sold it to you. And it was as simple as a phone call sometimes. Now that evolved through obviously the latter part of the last century, I think, and into the kind of 2000s. And the relationship with an advisor became more about that relationship and a little bit broader planning. Still pretty product centric. At the end of the day, there weren't a lot of ways to make revenue in our industry unless you provided a product at the end of the day. So, when I started in 2012, I guess, I kind of saw planning was a way to help sell the product. That was the way that the industry kind of set things up for insurance or investments, and maybe the same for mortgages and other things like that. But I'm not so sure. And now the level of professionalism in our world has gone up a lot, from different designations and more expertise, and a lot of, I think, the value and emphasis on financial planning has really come out of more qualitative approach. So we've kind of turned from a transactional to a relationship to now really getting deep on people's values and understanding how can we best align their financial decision making to their life's goals instead of their life's goals just falling in line with their financial situation. And I think that's a big shift. So we're definitely making a lot of moves right now in the firm to be at the forefront of that and to help people through establishing those life goals and then making sure their financial decisions fall in line.
Brian, you've got to see some massive changes in what Mike just said there. Like if you look back at your first 10 years in the business, can you give us a kind of a short description of what that was like as far as the pressure, the type of environment it was versus what we have now, just for comparison?
Well, the big thing was the industry was very product driven, and personally, I think that was a mistake, but that's what it was back then. And I'm thrilled that the industry has moved to a more planning base where we're looking at what the goals are for a client, looking at what their needs are, rather than just providing a product. And things were very transactional. And don't forget that the insurance companies didn't offer really investment products until late 80s, early 90s. When computers came in, that's when they really were, jumping on board that train.
Yeah, amazing. So much change, right?
I think it also helps the client even understand what their goals are. Probably one of the most challenging things for a person to do is actually put their goals down on paper, to actually verbalize them, right? And to think that, what do you want in 5 years? What do you want life to look like in 10 years? But we really want to harp on what's it going to look like when you retire.
Right.
That's a really challenging thing for somebody to do if you're, got a family and you're running around and you're going to sports and you're playing taxi and you're an ATM and you're doing all those things and you're doing your job and you're running around with your head cut off. How are you going to take that time to do that without a coach, without somebody that's going to hold your hand? I think it's pretty challenged for that to happen.
It's tough, and it's tough to get those goals solidified for sure. I think people have a hard time. I think sometimes when I ask people, what are your goals? People will put down goals that are common. It's almost like when you're a 5-year-old and you're trying to draw a cloud, everyone draws it the same way because that's what you expect a cloud to look like. So when you ask someone, tell us about your goals, I think sometimes they say, well, I want to retire at 55. I want to, and they say the mantra, which a lot of people around them want, but they haven't really taken a moment to dig in and figure out what gets them up in the morning, what's exciting to them, what's going to make them feel full and compelled in 10 years' time. And I think that's what you were getting at with your own value question when you wrote that blog last week.
Yeah.
And then there's if you solidify your goals, this is something I learned, like Dennis Mosley Williams. I think some people have heard of him. Yep. So he talks about this planning, going from right to left as opposed to left to right. And if you look at that from why that's important, is because if I say, I want to, for me, one of my bucket list things is I want to climb Everest, but I want to go to the advanced base camp. I want to do that hike where you go to Nepal, you climb up to the top. You're with the hikers, but you kind of lose them around 20,000 feet. So I think if that's my goal, if I say that's my ultimate goal, I picture myself doing that. And I say, okay, if I work from right to left, that means that it puts me into a timeline now that I can't back out of to some degree. Because now I visualize it, that's what I'm going to do. Well, that means that at least 12 months before, I have to have all my ducks in a row. I have to have my air purchased, the trip is booked, all these things. Well, how long is it going to take me to set aside my plans? Well, that's going to be, let's say, 24 months before that. And you start doing that, well, suddenly you're on this 3-4 year timeline where you have to say, well, this has to happen now. I have to start making those arrangements, doing the funding. If you just kind of have that long-term vision and you don't actually commit yourself, I'm not sure if it ever really happens. You just kind of keep pushing it off and pushing it off, saying, well, one day I'm going to own a sailboat, or one day I'm going to, live down south.
Yeah.
But if you don't commit yourself in as part of your plan, it really doesn't get you any farther ahead.
There's a bunch of things coming through my mind, and I'll take a second here to comment. It makes me think back to the question of what is financial planning. You can compare it to being in an airplane, and kind of the process that pilots go through when they leave, let's say, LA and head to New York City. Like, for hours and hours ahead of time, they've got a flight plan. They've got everything mapped out. They know exactly where they're intending to go. They know how they're planning to get there. They know the weather expectations, the forecast. They know what things are supposed to look like, and they plan accordingly. But no flight actually goes exactly according to plan. They have to make adjustments along the way, or else they're going to end up at the wrong destination.
Sure.
That's exactly what financial planning is. You've got your financial plan that sets you out on a course, and financial planning are really those adjustments, whether it's a couple times a year, sitting down, taking the space and time with your advisor, your spouse, your business partner, and asking yourself those questions to see, are we still on the track that we intended? Are there maybe some headwinds that have come that we didn't originally expect? And how are we going to navigate those?
Okay.
And I'll tie this up a little bit with this. To me, it stands out as like the penultimate example of a financial advisor or planner playing the role in working with said client. There's this advisor who tells a story. This is a true story, and it's not mine, but a client comes in, in some of their kind of initial meetings as they're building trust and getting to know them. The client says something to the effect of, man, I really wish I could spend more time with my daughter. I'd love to coach her soccer team, but, work's really tight right now. I've got all this debt I'm paying back from school, yada, yada, yada. Right now, I just can't. I got to work overtime. Fast forward 3 years later, client comes back, and he or she has paid off their car. So he's like, oh, I've paid off the lease or paid off the car. I think I'm going to buy this new car. I've got, I'm going to get this brand new BMW, whatever. And the advisor says, oh, that's really interesting. I just want to remind you of something you told me a few years ago. You wanted to spend more time with your daughter, and you were thinking you could coach her soccer team. Would purchasing this car make you more likely to be able to coach your soccer team or spend time with your daughter, or less likely?
Right.
Or has something changed?
And I have to work more.
Or could you maybe wait 2 years to get the
Right.
new car again?
Yeah.
And that, to me, just like perfectly epitomizes what we do.
It's rubbing up against the values. It's going to prevent
Totally.
a goal. Louis, what are you seeing? Because I know you're coming in, you're fresh you have fresh eyes. What do you see in this world?
Well, I think for me, and coming from the bank, and it doesn't matter what color the bank is, but it's very, when we think of financial planning, it's very quantitative, right? We're thinking about, what percentage am I funded for retirement, or to buy my house, or to buy my car, or whatever. But it's exactly what you guys have described, which is the qualitative portion that we forget. There's a happy marriage between the two, right? Like, that's the equilibrium that I see with my fresh eyes, which is, I want to retire at 55 years old. Well, why? What does that look like, right? So now we know that we need to figure out the quantitative portion, but what does the qualitative side look like? And it's exactly what Mike described, right? It's maybe coaching your daughter's soccer team at 55 or whatever the age is. So for me, I've always seen financial planning as very kind of black and white historically, but it's so much more colorful than that. It's about so much more about your values and your beliefs and what's right or what's wrong for you. And I think that's, the biggest takeaway that a client can have from going through an exercise with a firm like ours, or a different firm, or a bank, or wherever. It's, you got to find the happy marriage between those two factors.
Of course. Nice thing for us is that, and I wouldn't mind if you could kind of explore a little bit more, expand on it, Mike, is that our firm has just added a new sleeve of offerings to our firm in regards to the ability and our scale and our ability to add financial planning, even though we've been doing it for some time.
Yeah, exactly. And that's an important point to make. I mean, a lot of advisors, not just our firm, but a lot of advisors out there were doing financial planning as almost like this value add. And it was maybe their norm, but that was kind of done with the expectation that there would be something at the end, like an insurance product that would fill a gap properly, or an investment of, you know, X amount of dollars to make it worthwhile. And the industry started to see some problems there, and we've talked about this and seen some problems with that. So instead of kind of doing that financial planning in a bit of an ad hoc, a bit of a, you know, a bit of a manner that was still knowing there was going to be a product at the end of the day, or kind of expecting that, we've now formalized a process to have financial planning and advice as part of our service and advice offering, and it's independent of products. At the end of the day, you know, you take I think the most clear example is the DIY investor. So if a client wants to do their investments themselves, they want to kind of run it themselves, typically they wouldn't come to a financial advisor, because the financial advisor,
Of course.
what was their role? It was to provide an investment portfolio. Well, now with what we're doing, we could serve those people. We do serve some of those people, because they come to us, they get broad advice on a variety of financial planning topics. And at the end of the day, and they pay a fee up front, or, you know, within the engagement, to cover all of those various topics, help them kind of map out a game plan to reach their goals, give them some accountability as well. But at the end of the day, they could walk away and implement themselves. They could walk away and implement with another advisor if they already have, say, an insurance advisor somewhere that they love and trust. So it's different. It's a really neat element, I think, that we've got on the go.
So it's almost as if, as a firm, we've kind of shifted to possibly different verticals, separate silos, where we're managing one's wealth out of one silo, and in the other silo, we're actually putting pen to paper and articulating those goals and talking about where we could fall through some of the gaps, the holes that are out there, with not really any expectation at the end from us as a firm for the client to continue to engage with us, right? It's almost a neutral, unbiased approach.
Yeah,
Exactly.
we want to be able to bring that objectivity, right?
Yeah.
And we know that the stats say that they're likely going to stay with us long term, and we love long term relationships. I think we're all in this. We all got started in this business because of that. But it's nice when psychologically you can actually just relax the conversation and take the pressure off.
I think that's where the industry's headed. I think that's, you know, we've had a massive shift. I don't even know if there's ever been a time in financial advice where it's changed so much. This past, 10 years. If we look at where it was 10 years ago and where it is today, and where the financial industry is going to be in 10 more years, I think it's a huge shift. You know, even Brian, you've probably seen massive shifts just in implementation, advice delivery, the way firms are run. Like, if there wasn't even firms before, it was always sole proprietors. You know, it was the big fish running the operation. So now, just the way that's set up. So I think this is just one more great addition on how we practice with our clients.
I gotta say, it's if it's not the best, it's or my favorite, maybe is a better way to put it. It's one of the best things that we have done since I have joined Ecivda. I just think that there are so many people who need advice, who deserve advice, and DIY investors are a great example of this. But beyond that, what about the people who maybe can afford a fee for service or an hourly engagement or whatever it is, but can't afford to save on an ongoing basis, but they want some direction in their life? Big ones that jump to mind for me are people who are going through maybe a separation, right? And they're seeing this disbursement of assets or whatever's happening, and they just can't commit to $500 a month or to move their portfolio over or whatever. And they, in my eyes, they still deserve advice, as I know we all agree, but we've just needed to kind of break those chains off a little bit. And, we've just got to take down the barrier, and which we've done a great job of, and mesh the two together. And I'm so in love with this new element that we've added to our practice.
Me too. I think it gives access like that to normal everyday families too. That's my worry with the industry as well. As much as we've done some really cool things, and I'm not just speaking about us as a firm, but the overall industry. but I believe it's punishing less than high net worth clients. Like there's a lot of high net worth clients will end up being someone that everyone wants to have as part of their practice. That's just the reality of it. But then if you look at your regular family, your working family that has accumulated good assets, worked hard for it, sometimes they're going to fall off the radar. They're not going to be considered a high net worth client. Sometimes they're going to need advice, but the way that advice is going to be delivered in the next 5 years, they may start falling off the radar and have a disconnect. Just not have the ability to be getting this. What's best for me? How do I build my wealth? How do I protect my wealth? How do I transfer this wealth to my family? And I think this is a way that they can do it.
Absolutely.
Well, when you look at how many people in Canada would actually have a financial advisor, and then one step further have actually engaged in completing a financial plan, the number's shockingly low.
Mm.
Like it's shockingly low, right? So it goes to show that as a firm, our thought process and our outlook is on track. When we look at what's going on with some of the brokerage type institutions that are out there, as Shawn alluded to earlier, there's account bandings. Most of the institutions are not accepting accounts under 500,000. Right? That can be a far stretch for your average double income family in Canada, right? It can be a big challenge. It can also be, we live in Ottawa, right? We operate in Ottawa. There's over 200,000 public servants that have a defined benefit pension plan. They too need to be doing financial planning. They too need to understand how they're going to spend their money. Even when you have guaranteed income, you still have to pay attention how you're going to spend it.
Sure.
Absolutely.
Massive issues, right?
Yeah. And everybody's got, there's intergenerational wealth transfer taking place. And all of a sudden you've got maybe these, public servants who aren't used to having money that's accessible because they've had money in these pension plans for decades. And all of a sudden their parents or somebody, beyond them drops a couple $100,000 or a couple $1 million in their lap.
Yeah.
That's a very overwhelming experience if you've never paid attention and you don't have somebody in your corner to help you out.
Brian, you've got a lot more experience than everybody in this room. So you've probably seen times, I'm sure you've got a horror story that you could share with us where someone didn't take advice, should have done something, didn't do something, and they've got you probably have a horror story for that. And maybe you could share with us a positive story about where you've seen a positive impact because someone followed advice.
Well, let me tell you a story. And this was back in 2008, and everybody knows what the world was like in 2008 as far as investment goes in the markets and the economy. It wasn't pretty. Well, we had a client that was 65 years of age, and they were a longtime client. They had a considerable amount of money invested with us, but they also had money invested elsewhere with another firm. And every year when I'd sit down with them, I'd say, okay, let's review your investments with us. And we'd go through that. And they were, pretty happy with the job we were doing. And then I'd say, well, how are your other investments doing? And there'd be a pause. And through most of the years, they would say, well, they're good. Everything's fine. And then in 2008, when I sat down to do the review, I said, how are your other investments doing? And I kind of got this look, and they said, oh, not so well. And turned out that the other firm had put them in 100% equity. So very high risk, not really where they should be with that time horizon at age 65. And they kind of looked at me and I said, well, how are they doing the investments? And they said, well, it was minus over 30%. And I just kind of shuddered and we compared what we were doing, and we were down too. I mean, the market was down.
Sure.
There was no about it. But we were, down like somewhere between 8 and 10. So it was a big difference. So I said, well, what do you want to do? And they said, well, is there a way out of this? And I said, well, we've got to do this in a smart way because we don't lock in losses for you. But at the same time, we want to get you out of this high risk. So what we did was we invested in something similar but better for them. And then over the period of time, as the market and the economy changed, we skimmed the profits off and moved them to a moderate investment that with less risk. And by the end of 2009, we'd made back everything they lost and a profit on top of that.
Nice. And
So
have you
needless
seen?
to say, the client was happy.
Sure, that's a great story. So have you seen a horror story where someone just completely didn't listen to you and then ended up in a really bad position?
Well, every once in a while you have a client who comes and they don't want to listen to you.
Right.
They think they know it all and they think they know the best way to do things and they don't want to listen to our advice. And that's the time where, we need to say to the client, I don't think this is a good fit. I don't think that, we can help you.
Right.
And let them go their own way because it's very hard to convince somebody that their approach is not the right one.
I remember you telling me a story one time about a client that had like a heavy investment in high tech, and you would give them advice to
Yes.
hey, we should be reallocating. You're heavy on this one asset class, and they didn't listen. I thought that's maybe what would prompt there, but maybe I'm telling the story wrong. Yeah.
No, I know the one you're talking about, and it was a client who had stock in Nortel.
Right.
And the stock was worth probably
not
$1
a good
million.
name in Ottawa. Not a good name in Ottawa.
No.
Yeah.
And the stock was probably worth $1 million. And I said, don't give us all of it. Don't sell all of your stock.
Right.
Just give us a little bit of it, and
diversify.
we'll invest it in
Diversify
with less,
different asset classes. Sure.
Less risk.
Yeah.
And no, they weren't prepared to do that. And they ended up losing all of it. Needless to say, we all know what happened with Nortel.
Yeah, that happens so fast, right? Like I had a client, like when I had met, this is going back when my earlier years, my very first meeting with them, and they had an investment statement, and it was about $30,000 balance on it. So it's my first introduction, just getting to know them, going through what we do and how we help. And he says to me, hey, just so you know, kid, like this, I used to have it was like $750,000. And he goes, so I'm well versed on investments. It looks like I only have 30 when he only had 30, but he said, I just wanted you to he's just positioning himself so that I knew. So I was like, well, that sounds like an interesting story. Tell me about that. So he says that when he had $750,000 because he was working for a high tech firm here in Ottawa, which isn't uncommon. It's very common here, but he'd be painted options. And then, so of course, it was working for nothing at the beginning of his career, but these had sailed all the way up, and he had a nice nest egg, and he was just a kid. Like that time, he was 30, 35 years old with this really nice, massive investment. And he had put in he was thinking others were starting to sell off their positions, and he thought, well, I'm fine. The position dropped by 20 or 30% one weekend before a Friday. So he thought, well, that's a drastic move. There was some bad news for the company. Things weren't looking great. So it was a big shift on their stock price. So he goes away for the weekend, and by the time he comes back on Monday, the stock position now has changed to 60% down. So he's like, wow, just last week I had a $750,000 portfolio. This year Monday I have a $350,000 portfolio.
It's hard to take.
Yeah. So from your personality perspective, you're not going to automatically decide it's very hard to pull the trigger and get out of that now, because you think, I'm locking all that loss in. Well, that's a mistake, because as the week goes on, it just deteriorates. And by the time that he decides to pull out, he's got nothing left. So it was just this, you see these kind of things happen.
Yep.
But when you're listening to someone talk about that happening to themselves with all of their wealth, you realize, man, that's it's precarious.
That's
So
that's a gut punch. Like
right,
that takes you down many pegs.
a lot. Because
Oh,
imagine a life of a 30 or 35-year-old. If you've got $750,000 in your jeans at 30, what that looks like at 50, if you did it right, and if you
yes,
had the ability
yes.
to hindsight. Of course, that's even in our planning, we can't remove all the risks, but we can mitigate some of that risks by good investment planning and that. So that kind of is a good segue actually, because we're talking about investments in our portfolios, and we did a lot of work in 2022, led by you, Corey, on how we readjust our portfolios. Why? Maybe just spend some time. Can you just maybe explain for us some of the changes we made, what that looks like, what that means to the average person, and how we can bring some value with those?
Yeah, thanks, Shawn. It's really, Brian talked about diversification, right? So it's really not having all your eggs in one basket. You guys both just talked about the Nortels, the JDSs of the world that were Ottawa darlings that people lost basically all their wealth to.
Right.
And so when you look back at that period of time, Nortel took about 30% of the entire Toronto Stock Exchange up. It was shocking, right? And so the path we've gone down is we want a true, solid, diversified, risk-appropriate portfolio set up for our clients. We deem what your time horizon is. We deem where you're going, what you're trying to do. And then we provide you with something that is not bulletproof, but something that can withstand the highs and the lows. The market is crazy volatile. The market will react on news today that doesn't really mean anything to anyone unless you need your money tomorrow. And so what we've done is we've created something that is resilient, that can provide you with exposure to all the asset classes. If you have all your eggs in one basket, you're going to get burned one way or the other. When it's going up, it's great. The trend is your friend when the market is moving up. And when the market crashes, it's like the saying is, catching falling knives. Well, I think this company's amazing, and I'm going to buy more of them, and it continues to fall. The stock price continues to drop. This is called catching a falling knife because it hurts like hell. There's no reason for people to do this, right? When you are doing retirement planning, when you are looking out over anything above a 5-year time horizon, the power of compounding is the key to our success, right? If you look at single-digit returns, you can be compounding in doubling a portfolio in 10, 12, 15 years, depending on your targeted rate of return. So by doing that, we have gone out and we have looked and we have scoured the marketplace and we have looked at who should we be using for our U.S. equity positions? Who should we be using for our Canadian equity positions? Who should we be using for fixed income? We've added a sleeve of alternatives into our portfolio. What does that mean?
And what's not? Maybe explain alternatives for.
So alternatives are something that are going to be uncorrelated to the market. And when you hear people talking about the market, we're talking about the indices. We're talking about the TSX, the Toronto Stock Exchange. We're talking about the S&P 500, which is comprised of your top 500 companies in the US. You have the Dow Jones, which is your top 30 companies in the US based on market cap. So we have all these different asset classes and all these different companies. And so what we're trying to do when we add in a sleeve of alternatives is we're trying to give you something that kind of simmers the ride down a little bit, that doesn't react the same way as the S&P 500, that doesn't react in the same way that the TSX does. We're going to see mortgages in alternatives. You're going to see direct commodity exposure. You're going to see infrastructure. Infrastructure is arguably the biggest capital spend play that we have going on in North America. We haven't seen bridges built. We haven't seen new rail lines. We haven't seen airports built like this in a very long time. We have semiconductor manufacturing plants coming back to North America. Why do I care, Corey? Because when capital is being spent in an economy, that's where your money wants to be.
Sure.
An airport. Is an airport ever going to lose money? Is a rail line ever going to lose money? Is a bridge that people have to drive across every single day to get to work going to lose money? The value of the stock might go up and down on a day-to-day basis, but I can assure you it's not going to lose money over a long term. So we're adding in these sleeves that are making a dramatic difference. And we're not going to sit here and pound the table and say that we're going to shoot the lights out and earn you 90% or 100%, or, you know, in the hedge fund world, this was called a 10 bagger or a 20 bagger, right? You're making 100%, 200%. That's not what this is, right? We're here to give you a consistent, smooth ride. And so our model portfolios, we've gone through back testing. We've combed the marketplace for the best asset managers that we can find for those sectors that we believe offer the best opportunity for our clients. We have created a committee whereby we get together on a quarterly basis. We review what's going on, what's happening with our peers, how are we performing. And I have to say, after 1 year of implementation, I'm super thrilled with all of it. And, you know, and in conjunction with everybody and in collaboration with everybody in this room, we have made some incredible strides. And I'm super proud of the team in terms of what we've accomplished.
Feels good. What's your experience been like, Mike, with your clients with this rollout?
Oh, it's been fantastic. You know, a lot of my clients, as well, our listeners may not know, they were clients of mine before I came to Ecivda. So it's a nice way to be able to bring them into the fold, you know, let them get to know the team and kind of the brand and the culture, but then to get to know the way that Ecivda actually does business and manages portfolios. So bringing the models out and kind of walking through them right from the conservative end of the spectrum all the way up to the more aggressive. They've been well received, and we've made a lot of kind of switches to just refine and tweak things and feel like we're in a little better spot as we look at an uncertain future, but a future that'll certainly be interesting.
Louis, Mike brought up culture. What's your thoughts on the culture? Because you've seen it. I know you both came in around the same time, but what's some of your thoughts on what you're experiencing that other people that come into our firm, you know, either as advisors or as a team member or even clients, what are they going to experience, you think, firsthand?
Yeah, well, I think, and these were super obvious to me when, you know, I started bugging you and Corey in December of 2021, and then we met later in early 2022. But it's, you know, you care for your people and you care for your clients, right? And a great example of caring for your clients, I'll start with that one, because I have a funny story about the latter, is, you know, we operate like a family office, right? We work with your accountant, we work with your lawyer, we work with your family. We want to help you transfer wealth. We work with numerous generations because we want the best outcome for you and your family and your loved ones. And, you know, coming from the bank background, it was super shocking for me. You know, we mentioned that Brian's been in the business for 51 years. It was mind-blowing, actually, is a better way to put it, to hear somebody say that they've been investing or working with Ecivda for 45, 50 years. And not just Ecivda, like they're name-dropping Brian. And I know he's the face of the firm, but, you know, like that's crazy to me. Whereas, you know, you're in the bank environment and again, it's nothing to do with color of the bank, but you've got a new advisor once a week. You don't have that same face, and people have that, right? So we've become very relationship-based, client-centric. It's not a transactional experience. And then, you know, in terms of caring for your people from an advisor, or if you're part of the admin team or the business development team or whatever it is, you know, I was thinking about this story on my drive over, which is, you know, you guys had asked me to join Ecivda back in early 2022, and I was really comfortable with the bank, and I was hesitant to make the jump because, like I said, I was comfortable. I had a very clear career path ahead of me, and I was nervous. And you and I met virtually to discuss kind of where my head was at, and I'll never forget this. And I think it was so awesome because it just like I was going into that meeting to tell Shawn I'm not ready, and he wants to tell me more about Brian and the team and the firm, and he puts up this PowerPoint that he's built. And he's got, the team page with everybody on the team and my photos up there. And he's like, yeah, I might have gotten a little ahead of myself. And I was like, and
that is
right. And like
Shawn.
my title was there, and I was like, oh man, like, what you never want to be is a number to your employer. And whether you're a bank or you're in tech or you're whatever industry, it happens. But I did not feel like a number in that moment. I felt like a person who was cared for, who was valued.
Remember that conversation too.
Right. And so anyways, that was my tipping point. I was going to tell Shawn I'm not ready. And next thing I know, I'm like, yep, send it over. Send the paperwork. I'm here. I'll start tomorrow.
That's awesome.
Yeah, that's great. Well,
Yeah.
it's been great. And
That is great. Yeah.
and I do feel lucky. Like we've got a great ensemble of people. It's like adding a team. Every single person has, different attributes and personality. But what was interesting is when we did this value exercise with a consulting firm that had come in. So Michelle Gervais had helped us and kind of just stripping you right down to the foundation, then bring you back up again and looking at all these things from a 30,000-foot view. But we all have very similar values. Like no matter where we came from or backgrounds or, our education, all of our values really line up. And then like even for you, Brian, when you first started this, and I'd come in the business with you, you had said, here's what you got to focus on. You got to look after people, treat everyone, with respect, trust, always be trustworthy, always hold your word. Like there's some very, we put on our web page about old school values, new world ideas, but old school values. And I think that's what we're talking about. It's like things like trust, and a handshake is a handshake, and our word is our word, and commitment. What kind of values do you think were really important for you on your path of success? And what do you think is helping us as a firm right now? And what values do you think are important for us?
Well, I think, Corey alluded to the changes in investment that we've made. And Mike talked about the changes in his career coming into Ecivda, and Louis leaving the bank and coming in with Ecivda. And even for you, Shawn, when you and I started working together many years ago, that was a big change for you and so on. And there was a pretty smart guy by the name of Einstein who said the only thing constant is change. And really, I think that's one of the things that set our firm apart is the fact that, yes, those old school values we've kept, and we've continued to emphasize those with our employees and our clients and so on. But I think we've been flexible enough that we've been able to change as the times change. We've been able to, do things like this, social media, to be able to reach our clients and be able to let them know who we are, let them know how we think and how we approach things. And I think that's the hallmark of us. One of the things, we talked about bad times for investment earlier. And one of the things that I think set us apart was the fact that, if you remember, Shawn, in 2007, in the fall, we called clients. We told them, we said, yeah, we're not seeing good things here, folks. And we think we better batten down the hatches and make a few adjustments here and there to protect you. Well, that's what said, the majority of firms, when 2008 come, they didn't want to talk to anybody.
Right.
They didn't want to answer the phone. We did.
Well, it's the same as now. I feel like now it's in that time of volatility. What I learned from working with you was that you have to be talking. We have to be communicating during really tough times. It's hard. It's hard because when we're working with clients and talking about goals and security, and they're expecting us to deliver and on a quarterly basis. When we do experience volatility, it's tough to be accountable. It's tough to sit in front of a client and say, we're down and this is why. And sometimes it's nothing you've done wrong. It's just that's just
Right.
the way the world or the economy is right now. But being accountable and being there and showing up to have that conversation, it's massive. It's a big part of that trust factor that I think I learned, like you said, in 07, 08. You learn that if you showed up and you opened the door to have that conversation and you could show that we're going to be there through good and bad, the client begins to trust you even more. And that relationship develops. And I think that's what's happening now. Even as we go through a really tough 12 months, arguably, that we've all shown up, we've all shown we care. We have an open door policy with all our clients, no matter what size account. It's like, we're here, we can help you. And I think that's part of the culture. So we're talking about change too, Brian. And I know, we've gone through a really tough year. If we look at cash flows for businesses and we look at what the average business owner is experiencing or focusing on, or even at the average family. But I know for us, from a firm level, what you're doing, spending a lot of time in the past year for us, is just talking to business owners about employee benefits or their pension plans. What kind of things do you see owners worrying about right now, or what should they be looking at when they're considering those things?
Well, I think one of the big things that all business owners, anybody who has a business is concerned about right now is two things. They're concerned about the high cost of things, and they're concerned about high interest rates. And, it makes doing business expensive. And so one of the things that employee benefits can offer them is a way to compensate their employees fairly, but at the same time to do it in a very tax advantaged way. Because, if you just turn around and give an employee a raise, the problem is that triggers so many other things. You've got CPP is going to go up. You've got EI, you've got workman's comp, you've got taxes. So there's all kinds of things. And it's not just for the employer, it's for the employee as well. And the employee's side of the taxes is even higher than the employer's. So, in the end, the employee kind of looks at you and says, well, gee, thanks for the raise, but, that really wasn't that great. Whereas if you can give them a pension plan, group RSP, or group benefits, the advantage there is it doesn't trigger all those other expenses for either the employer or the employee. So it's win-win. Both sides win. And from the employer's perspective, it's a tax write-off, which is great for business. And, the only other tax that's involved is the 8% Ontario tax on the premium. And that's it. No other taxes, no other expenses. So it's a real win-win for them. And the employee can look at that too and say, hey, I got full benefit. I didn't get just part of it. I got all of it. So it's a win for everybody.
That's good comments, Brian. So based on what he's saying, what do you guys think? How important do you think benefits are going to be for the average employee right now?
Massive.
Yeah.
Massive.
It's huge. It's the cash flow crunch that is happening out there because of the increase of interest rates it's dramatic. You're going to the grocery store right now where even a year ago, the average spend might have been $1,200, $1,500 for a family of four. You're blowing through a couple $1,000s a month now. You might be close to $2,500 a month in groceries. How do you eggs
Fuel
at
bills.
$10? Milk at $8-9 for a liter. Like, this is crazy.
Lettuce. Oh my gosh.
It's so impactful, right?
lettuce.
And that when you used to make that run to the grocery store and you'd spend $100 and you'd get 5 bags. Well, now you're lucky if you have 2.
Right?
Yeah. For me, what I've enjoyed the most about even my particular employee benefits plan is the wealth spending account, right? Like it's been a crazy 12 months for everybody. There's nobody who can really say that it hasn't been hectic. And for me, what I did is I took my allocation from that wealth spending account, and my girlfriend and I, Cheyenne and I, went out and we got bikes. and we would
Nice.
just bike in the summer
Awesome.
for our mental
Nice.
health.
Yeah.
It was, yeah, like it was just it was a break from the craziness of COVID and the markets and frustrated and nervous clients, and with even my own personal investments, and it's tough. But if there's one gift that I was very glad to have gotten, it was a little bit of peace of mind and some mental health recovery for sure.
That's great you said that, because we get so much good feedback about that. Like
Yeah.
that, we just started that 3 or 4 years ago, and it's not like we're the only ones. Anyone can set up a
Totally.
wealth spending account, but I like the flexibility of it. Like, the reason we did it was because I was away. I was listening to a conference speaker talking about bringing happiness into your workplace, even into your home. Like, just how impactful it is to be a happy person, genuinely happy person, how infectious it is. If you're happy yourself, then people around you also become happy, and dialogue changes, how they feel about themselves, how they feel about you, your interactions, the positivity. So important. So the challenge this person left to us was, what are you going to do to make an impact, to make someone else happier? So that, okay, you know what, that's a really good point. I'm going to come back, had some talks with everyone here, and we decided we're going to put in this wealth spending account, that there'd be a certain amount of dollars set aside for everyone on the team that they can spend on whatever they want. It's whatever makes you happy. If it's a yoga class, or signing up for lessons or art lessons, or putting it towards a bicycle, or if you have a pet and you want to spend it on your pet expenses, whatever you desire. I just want to make sure that there's some connection between your employer and your happiness, if you want. And it was just perceived so much differently, because I could give you the money, but that's different than saying it's there for you to put towards something that you want. And it's nice. I think it's a nice way for employers to utilize that.
It was, yeah. I mean, there's, we've seen our fair share of different employee packages, and I've already got big plans for my allocation for 2023. I don't know if it's going to be joining a golf club,
wow.
or sorry, a club, or squash is on the radar,
Nice.
potentially with a buddy. So
Nice.
yeah, so I've got big plans, and I'm grateful for it. I think it's
That's
excellent.
huge.
Yeah.
Oh, that's great. So clearly it's a great addition to, for any employer to consider, things like healthcare spending account, the WSA. I know our group has a lot of experience, so maybe we'll just spend a little time going around the room. Maybe everyone has a few tidbits they want to share on what might help, or a suggestion for 2023 for, you can be a business owner, could be a professional, a retiree. What would be your 2 or 3 tips you'd want to share? And maybe I'll start out with you, Louis, and we'll just work ourselves around the room here.
Yeah. So I'll start with the business owner. So there are 3 main, and it's pretty broad, but it's, pay yourself, invest in your business, invest in your people. So invest in your people is stuff like the wealth spending account, right? You're only as good as your people. Invest in yourself, I guess. For me, it's not, is it my TFSA or is it my RSP? It's sitting down with your larger advisory team, and is it a salary or a dividend, right? Because the dividends are wonderful, but there's a bigger picture at play, and then invest in your people, or in your business, excuse me. So if we think about people who were extremely successful during COVID, first person or first job that comes to mind are realtors. Right. So maybe
Yes.
you're an incorporated realtor, and after, the year, you've paid your taxes and you're sitting with this huge sum of cash in your bank account, and you've paid all your deductions, and now you only need $50,000 to pay your lifestyle expenses and your mortgage. That huge sum of money still sitting in your bank account. I don't think many people know that there's so much more that you can do with it other than just have it sit in your bank account. Right. Like, you've got so many options, and not to go on a tangent, but it's just awareness, right? You've got so many options. So those are my big 3.
For me, I go back to that blog post that you referenced earlier and a few weeks ago, and just, beginning of a new year is always a good time to kind of reevaluate your values and realign and kind of get things squared away. So if you've been through the last few years and kind of chasing your tail a little bit, which I think we all have, if you can find some space to reflect, and sit down and think about with the people that you're closest to, if it's your spouse or it's your parents, if it's your business owner, partner, whatever, and lay things out so that you can go into the year with a lot of intentionality. That would be kind of my overarching theme. And kind of coming out of that, I think maybe it's because I just spent some time with my parents and we were talking about some of these topics. Estate planning, I think, is often overlooked, and it's not as simple as just a will and a power of attorney. There's a lot that goes into passing down values, not just wealth, and having, kind of communicating your intentions to your family members. If you're, if you're probably at any point in time, it would be helpful.
Yeah.
But certainly if you're 55, 65, 75 plus, I think having those tough conversations about what you really intend and why you're setting things up a certain way, it makes sure that people aren't kind of scratching their head after the fact when they can't have the conversations with you and wondering, well, why did they do that?
Like a family meeting.
Why did they do that? Yeah, a family meeting.
Yeah.
And you can have all the money in the world, but you can still be miserable. So that communication is absolutely key, and I think those family meetings can go a long way.
Okay. Good point, Mike.
I think my top three. Well, for people that are self-employed business owners out there, I think it's a good time to be considering, what's my succession plan? I've built this castle. I've built my empire. Now what? Who, what, where, and how am I going to move this along the lines? How am I going to maintain this legacy of this wonderful entity that I've built? And I think for the professionals out there, it's time to do some planning. It's time to consider, where am I going? How am I getting there? And my third, I think we just need to play some more golf this year too.
I'd be okay.
Can't
with
argue with that.
Okay, so for me, I think kind of on top of my mind right now is, for most business owners, it's been common, and especially because we've come across these cases the last couple of months, where talking to an owner, they've got a couple of partners, 2 or 3 partners, they've set something up that was a really great idea, and at first, I'm sure it just got off the ground, but now it's 2, 3, 4, 5 years later, it's got traction, business is working. They don't have a funded buy-sell agreement, so they've got casual agreements between the partnership on what it might look like, or who's going to take over, or who's going to run it if someone was to get sick or die or get injured. Long term, I think it's a long-term injury that is, that would really cripple a business, but really no funding there for that. And when you bring that up in a conversation, I just see it start to really become something they start worrying about. It's
Deer in the headlights.
yeah, it's like, have you considered what would happen if that business partner was not to come back for 2 years, 5 years, can't come back? If we're going to fund this exit, how are we going to do this? So, who's going to become your business partner? So that's important. I think professionals, if I look at professional market, one of the ones that comes across the low-hanging fruit is often they're doing very well, income is high, often higher than average, but sometimes just they have not spent enough time just ensuring that, again, same topic, just different format, I don't have enough if I get disabled. Usually disability insurance is a gap, huge gap. Yeah. They've got a great profession, they're making good money, but they haven't protected that income. So it's like they've got a lifestyle that matches the income, they've got goals that match the income, they've got a family, they've got purpose, but just no ability to secure that. So
and if you've been compensating yourself through your business and you haven't done any other planning, and that terrible event does happen where you have the inability to work and you are the key person of your firm, you can't just continue to take from the business piggy bank.
No, you can't.
This will end poorly.
It does, right? It does. You're devaluing your own business because no one's going to want to take that on. There's just, you can't create revenue. This became
so many compounding issues.
Yeah, this became very evident to me when I had my ATV accident. Yeah. And it was a great day. We'd travel, out with clients and friends. Experienced ATV rider, and I flipped my ATV, break my back in 5 places. I'm in the emergency at the Ottawa hospital, and I thought, man, I don't even know if I'm going to be able to work again. So it's like fear sets in because you realize, oh my God, what am I going to do now? Because I may not be able to go back to work. So you start telling that story enough times, they start thinking differently. But that's where I see it. And I think for retirees, my last one, it would be retirees. I think it's just want to make sure we can generate enough income and longevity of the income source. And sometimes they've experienced good returns, good income in the past 15, 20 years because they've been invested a certain way. Doesn't mean that's the proper allocation for them in the next 10 or 15 years. So I think for me, it's taking the time to look at what's their ultimate goal and spending the time to match that up. So it's squared away.
And
right?
planning will help a
Yeah.
retiree understand how to deaccumulate.
Yes.
Right? The industry has been built to accumulate wealth. Well, once you get into retirement, you can't take it all with you.
No.
You have to understand what accounts to take it from first in a tax efficient manner. So you're spot on with that, Shawn, for sure.
And Brian, what about you? What's your thoughts there?
Oh, so two of my three have already been spoken about, but I'm going to put a little different slant on them. So the one is in terms of protecting yourself. So I think it's really important that you protect yourself. And, unless you've got a card that says you're guaranteed to live to 90, then you better get some protection for
Where do you
yourself.
get that card?
Yeah. How much,
Yeah.
how much is that card?
I want that card.
You never know when that's going to happen. And so you need to have that. But, the other thing that goes along with that is your investment. You want to make sure that if something does happen, you want to make sure if you're a business owner or professional, that those investments are creditor protected as well. So don't forget that. With regard to the buy-sell funding, that Shawn mentioned, I think that's really important because if you don't do that and it's not properly funded, what's going to happen is your partner's spouse or children are going to become your new partner. And you may think they're wonderful people,
Very, very bad.
and you may think, I like them, but I don't want them as a partner, sort of thing.
Yeah.
So, protect yourself against that. And the last thing is, I think it's important that a business person or professional take money out of the business as they go along. Too many business owners want to hold on to everything, and then they get to retirement and they say, okay, I'm going to sell the business. Well, what if you can't get 100% on the dollar? What if you can only get 50 cents on the dollar? Or what if it's not a good time in the economy or whatever to sell that business?
Sure.
Well, if you took money out over time, put it in a tax advantaged place that was safe and grew it, then you don't have to worry so much about that final sale. So I think that's important to remember as well.
Those are pretty good points. I think that's
I like that last one a lot.
if we got someone to follow all that this year, they'd be in a really good spot.
Oh my
actually.
goodness.
Yeah.
Would they ever?
Really good spot.
Well, it's been an absolute pleasure to get together and have the team here. And again, welcome. And I'm so happy that you, Louie and Mike, have joined us. And I want to do a quick shout out to our staff at their firm, Jackie and Natalie and Stephanie. We have very much an East Coast flair going on now. We've got two from the Rock in Newfoundland, and we've got one from Cape Breton, and so we've got this flair going on, which is absolutely wonderful. And we've
Just a quick addition, shout out to Doreen as well, because I enjoy my paychecks.
Yes.
Just
That's
wanna-
right.
oh
That's right.
wow,
wanted to make sure
Louie,
that
there's
was-
something brown on the front of your nose right now. You might need a
Very well
Kleenex
Smart
to wipe
man.
that.
Smart man.
But
Thank
that
you,
is a
Brian.
good point, though. We were talking about the addition of the advisors earlier, and we did have some really good additions. We Stephanie joining our team, same time that we brought on and Mike and Louie it's been an exceptional addition to us. She came in from a different industry, quick to learn, well loved by our clients. She's a go-getter. She's a powerhouse. Kind of reminds me when Natalie joined as well. Natalie came in from a different industry, totally unrelated, but just a complete powerhouse for our firm. So we've continued to have some great additions. And of course, Jackie, as we know, has been here since day one. So
Amazing.
well loved by clients. We've got a great support team. And of course, and Doreen being my mom, I'm really fortunate to have, there is that element of family business where I have Brian and Doreen as part of this. So I'm very, very fortunate. It's very much an East Coast family style team.
I
Well,
like it.
we definitely have a wonderful family office and flair going on, and we thank you all for joining us today, and we look forward to you listening to us again.
Looking forward to it. Thanks, everybody.
Thanks everybody.
Corey.
That was fantastic.
Awesome.